Welcome to StockOdds, Odds and End podcast. I'm Dave Singh here with Rob Friesen, getting ready for the week ahead. We're approaching the end of January, just in there a couple days left. Good evening, Rob. How's everything?
Not too bad. I mean, we've got a full week, unlike some of the 4-day weeks that we've had already this month, right? So a full week, and what do we have? Like lots and lots of earnings. I mean, this
Tons.
is the next 2 weeks are when most of the S&P does report. So it makes it tough, but you have it every quarter to deal with, and so here we are again. We're arriving at that now. Asian markets are closed. That's pretty much the whole gamut of them, and it's the year of the rabbit, Chinese New Year here. Lunar New Year of the water rabbit, I think it is. So we'll see how that plays out this year. I put a lot of meaning into it, but I don't know if the market plays out that way or not. But anyway, it's the year of the rabbit. So let's get hopping on the subject here of what's on the economic calendar for this week here.
Yeah, so in terms of economic reports, Monday we have the leading economic indicators at 10 a.m. Eastern. Tuesday we have S&P manufacturing PMI. Wednesday, not much. Thursday, there's a bunch of reports. A lot have to do with jobless claims and GDP numbers. And then Friday, we have consumer spending and PC price index, so inflation data. So there's some themes here: inflation data, manufacturing performance, but mostly it's going to be about earnings this week. Tons of earnings reports.
Yeah, well, so on that note, I mean, we saw even on Friday, right? We had quarterly results from Netflix and Google, right? Alphabet. And that really, I think that contributed to, Friday's move. I mean, Google was announcing plans to reduce its workforce by about 12,000 roles. This is the thing. People always look at that as negative, but from an investment perspective, when companies are laying off, we see that as positive because, the amount of revenue per employee or margins or, more money to the bottom line or whatever, right? So and we know that, there's a lot of people that were added to the workforce when there was a lot of free money sloshing around. So and there was a lot of incentives and programs to hire and retain and all that. So I think we're on the tail end of that where we're seeing just a lot of those people that had been added being laid off or the non-performers of them all maybe. But I think, these companies can certainly handle it. More efficiencies come in and more automation is being done. And I think this is a trend for at least this year, maybe next year as well, where more and more layoffs. So don't be like thinking negative when you hear that, because you have to look at it from a contrarian takeaway perspective. Okay, investment returns could benefit from a workforce reduction. Yeah.
Yep, very good. Monday we've got earnings, some financial stocks like Synchrony and Zions Bank. Tuesday there's a big one, Microsoft, that could move the Nasdaq quite a bit in the markets. And then Tuesday we have a lot of other ones too: 3M, Danaher, DR Horton, GE, Lockheed Martin, Verizon. So Tuesday is a huge day for earnings, many stocks. So you have to check your symbols against that. And then Wednesday, Tesla, right? That's always an interesting one to watch. And there's other numerous ones like General Dynamics, IBM, AT&T. So that's so I think Wednesday and even through Thursday. Thursday we have Visa, another big one. Again, tons of earnings: airlines, MasterCard, Dow Chemical, Southwest Airlines, Valero, Steel. So you name the industry and it has earnings this week. And Friday, American Express, Chevrons. So these are big companies. It's like one of the most significant weeks in terms of earnings and the big names that everyone follows. So every day, I think we have to check our individual symbols against these and make that judgment call. Do we include it in the basket still, or take out all those?
And that's a tough time, now with so many earnings, of course. But the thing is, it doesn't always mean it's bad if a stock's reported and it's gapping down. I mean, some of the comeback tours that we've seen on these stocks can be very rewarding. Mm-hmm. So it's your choice to leave them in or pull them out. But it just some seasons get really tough because you got to pull so many symbols out if you're just a non-news orientated person. Like you just want to eliminate all news. It gets pretty tough. But anyway, don't be afraid if something is already pre-market gapping down a lot. It could go lower, but it also might have that comeback tour that we've seen many times.
And things are pretty efficient in terms of pricing. As soon as the news comes out pre-market, it gets to a certain level, and I've seen that's pretty good. I mean, it kind of goes back to that quite a bit throughout the day. So maybe the market's super efficient now with interpreting that very quickly, the earnings. Mm-hmm. But yeah, and then in terms of the 10-year note, yeah, go ahead.
Go ahead. Okay, go ahead.
Yeah, in terms of the 10-year, we're still at 3.47%, just down slightly overnight. So for the year, we've come down a bit from a little over 3.8%. So the bond market is predicting that the Fed really can't keep interest rates that high, or they're not believing it.
Where's the market so far this year to date? Remember, we talked a lot about expecting some tax loss selling rebuying, in January, and that's what causes the mid-month seasonality bump a little bit. Mm-hmm. And so to that note, as of Friday, here's where we are. The NASDAQ is up 6.4% year to date. The Russell is up 6%. S&P mid cap is up 5.3, and the S&P 500 is up 3.5, and the Dow is only up 0.7. So last year, the Dow was the best performer, only down 8% or so for the year, or 8 or 9, whatever it was. And of course, the NASDAQ was down 31% for the year. So, you're seeing a bit of that slight mean reversion. I mean, it's the Dow's lagging, and NASDAQ's already come back 6.4% since the beginning of the year here. So keep that in mind. That means that they're nibbling at these tech stocks. Every day we kind of watch for that, and Friday, it was again the same theme, is that the NASDAQ seemed to have that leadership and power it up. Compared to the other groups. So the very first one to roll over after the rally off the bottom there on Wednesday, I believe it was it was Tuesday or Wednesday, sorry, was the Dow, right? It pulled back the hardest. And Friday, like we had our S&P list didn't do very good because it had a whole bunch of defensive stuff long, and it had some discretionary stuff and tech short. And of course, that's what dominated on Friday. So normally with expirations, things kind of have a bit of a move at the beginning of the day, and then they kind of settle in and go sideways. But what happened on Friday was it kept picking up steam, and NASDAQ was definitely the leader. So we'll see if there's some follow through to that. Just remember that Asia is offline. There's no markets open. So that could impact a little bit about, how do Chinese related stocks do? How does some of the tech stocks do? Could be related for tomorrow anyway. How are the futures doing right now? We've got the Dow Jones futures kind of flattish, down only 15 points or 0.04%. S&P down 2.75 points or 0.07%. NASDAQ is also down 0.07% or 8 points. Russell is down only 0.03. VIX is down 0.41. So it's not showing any fear. We're at the 21 level on the VIX. We had a recent little bit of a pop up over 22 and now back down to 21. So not seeing any real fear from the VIX. Of course, this week being, a lot of earnings, something could set it off. No different than Netflix earnings on Friday did offer a boost to technologies and communications in general. That was the leader, was communications, and tech was second, I think. So, these earnings can matter and it can impact your groups. Dave and I have been talking a lot about, curating particular buckets for what you want to represent, like a theme. So it could be, low PE multiples versus high PE multiples. Could be low beta versus high beta, these type of things. And what that allows you to do is really capture the sentiment and the, aspirations of the market. What are they focused on, and take those groups and actually put them into your web screener and then export your results from that so that you're actually getting odds on particular universe that you've constructed, right? That you understand why that you put that universe together and what it means to you, and then sort of curating odds and average performance from that bucket, right? I think there's a lot of merit to that. And so you can use those on particular days when you see risk on versus risk off, right? Okay. What else? You had some
we have the almanac
seasonality. Yeah, you have the almanac to cover.
Yeah, so
for January. Yeah, go ahead.
So the last 5 trading days start this Wednesday.
That's correct.
Some of the sectors that are expected to be more bullish versus bearish: gold, XLU, XRT, silver. These are things that are typically more bullish. And then things that are more down in that window are the risk-on things. ARCG, minus 1.9%. The KRE, I think regional banks, minus 1.86%. The SMH, minus 1.8%. Energy, XLE, XOP, both down more than 1.5%. So oil, a lot of the risk on, and some financials weaker, and even some of the biotech, IBB, where more strength in gold and something defensive like utilities. And if you look at the 3-day perspective, the last 3 days of the month, it's also very similar, with gold, silver, and utilities stronger than the risk-on stuff. Same theme as the 5-day. And then the final day of the month, it's in line with the same thinking, right? Strongest are gold, silver, utilities, and weakest are financials, chips, basic materials, and energy. So that theme is pretty solid for the last 5, 3, and single day of the month. And most of the gains for the month really are in mid-month seasonality and that options expiration Friday. And typically for January, it's really soft that final week. So the first 2 days of this week, we're not in that window. So it could be either way, maybe driven more on earnings, but the backdrop really is kind of bearish for the next couple of days.
That's the seasonality for sure, and it is, historically accurate that we get that bump in the mid-month, and that's just due to 401k payroll deposits and the 30-day wash sale rule, where people have to wait to buy back stocks that they may have sold for tax purposes. And I think, I don't know how distributed the tax loss selling was, but it seemed kind of like a pretty consistent pace through the month of December, right up to December 28th, 2 days before the end of the month. And so, you know, if that last week there was still quite a bit, I mean, they could be buying that back this coming week or the week following, which could interfere with this weakness that we see on the seasonality calendar. But I would still tend to put a fair amount of weight in the seasonality calendar. And, you know, hey, if it surprises us and it continues to rally, then fine. We're not going to argue with it. But that's the case of having that perspective and then allowing it to be what it is, probability based, and look for any macro things that you know, interfere, come out, right? So all right, anything else from your perspective?
That's it. From my research, that's it. Yeah.
Okay. Let's just flip over to what's going on in metals, because metals have really been about the US dollar, right? And so the US dollar right up to Friday had continued to decline. With the futures now, it's down again 0.34%. It's coming up to the low that it hit on January 18th. If it gets below that, which coincides with last year in May, the low, if it gets below that, there is a bit more of an air pocket again. I'm still expecting that the dollar trade, which was really crowded, is still unwinding, and that does support the metals. So, you know, we've had a pretty good run since November in gold, and I don't think that there's too much resistance until we get to around the 2000 level on gold. We're at 1936 right now. So it's going to be interesting. Silver has been a little bit of a lagger behind the gold, but it's channeling. If it breaks out of the channel up through $25, that could be healthy. Copper has seen some good rise since the beginning of this year. And really what kicked in for copper was China reopening and more, you know, industry starting up again and things like that. So recession is directly tied to copper, and it seems that it's arguing against a global recession of, you know, a major magnitude, but who knows? It's just copper's on the rise. And like Dave pointed out, for the bonds, you know, the bonds have been not expecting the Fed to be as aggressive. They've kind of tapered off and they're kind of rolling back and forth now. And with energy, we had a pretty good move back up over 80 from we hit as a low of around the 70 a barrel on West Texas in December, and we put in a higher low beginning of this year. We're back up to 81. There's you know, potential for it to trade back towards 90. That's not out of the question, but it just recently had a 2-week move here, so it could roll back down as well. So it's off now 0.39%. Brent crude is off 0.43%. So there's a little bit of weakness showing up at the moment, but the dollar pulling back can keep a little bit of floor under it, more of a floor on the metals, of course. So I hope that helps. You guys have a good week. As Dave said, check your earnings calendar, be on top of that, and we wish you all the best.
All right, thanks. Good luck.